Gold is trading at approximately $4,933 per ounce as of February 18, 2026. Not long ago, analysts who predicted this price were dismissed as fringe thinkers. Today, those same analysts are being invited onto the most prominent stages in global finance to explain what they saw that the majority missed. The question worth asking is not simply why gold has risen this dramatically. The more important question is who knew it was coming, why they loaded up on the metal with such quiet confidence, and what that tells us about where we are heading from here. To understand the gold story properly, you need to step back from the daily price charts and look at the broader architecture of the global economy. Something structural has changed. This is not a story about speculation or fear-driven panic buying. This is a story about the calculated repositioning of the largest and most sophisticated pools of capital on the planet. And when you follow that money carefully, the gold surge begins to make complete sense. Let us start with the numbers, because the numbers are staggering. According to the World Gold Council's full year 2025 Gold Demand Trends Report, published in January 2026, total global gold demand exceeded 5,000 tons for the first time in recorded history. The value of that demand reached an unprecedented $555 billion, a 45% increase year over year. The LBMA gold price set 53 separate all-time highs during 2025 alone. The annual average gold price came in at $3,131 per ounce, a 44% increase over the 2024 average. By the fourth quarter of 2025, the average price had reached $4,135 per ounce. And as we stand in February 2026, prices have continued pushing toward the $5,000 level. That is not a blip. That is not a speculative bubble driven by retail enthusiasm. That is a sustained, data-backed, institutional-grade bull market that has been building for years. The gold price itself opened 2024 at approximately $2,063 per ounce. The journey from that level to nearly $5,000 in roughly 2 years represents a gain of more than 140%. To put that in context, the S&P 500 index, which is considered the benchmark for global equity performance, delivered strong but far more modest returns over the same period. Gold was, by virtually every measure, the top-performing major asset class of 2024 and 2025. The Guardian described it as gold's strongest annual performance since 1979. State Street Global Advisors, one of the world's most respected institutional asset management firms, published a 2026 outlook suggesting gold could consolidate in the range of $4,000 to $4,500 per ounce, supported by Federal Reserve easing cycles, persistent structural demand, and ongoing geopolitical fragmentation. Goldman Sachs, the firm that tends to shape institutional consensus more than any other, raised its year-end 2026 gold price target from $4,900 to $5,400 per ounce in January 2026. JPMorgan's global research team, in a December 2025 outlook, described gold prices as expected to push toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 per ounce identified as a realistic possibility over the longer term. These are not fringe forecasters. These are the most powerful financial institutions in the world, and they are making directional calls with high conviction. Understanding their reasoning requires examining the deeper forces driving this market. The first and perhaps most structurally significant force is what financial analysts are calling the debasement trade. Governments around the world, most prominently the United States, have spent the past several years adding to national debt at a pace that has no modern precedent in peacetime. In 2025 alone, the United States federal government added approximately $2.25 trillion to the national debt, bringing the total national debt to levels that dwarf anything seen outside of major world wars. The Congressional Budget Office forecasted the U.S. fiscal deficit to reach around 5.8% of GDP in fiscal year 2026. Goldman Sachs' own investment outlook for 2026 noted that the U.S. fiscal deficit is unusually large relative to the economy's strength, with the debt-to-GDP ratio approaching post-war highs. When governments borrow and spend at these extraordinary levels, They are implicitly diluting the purchasing power of their currency. Gold, which cannot be printed, cannot be created by a central bank balance sheet expansion, and cannot be digitally manufactured, becomes the instinctive antidote. Sophisticated investors do not wait for inflation to arrive in a visible, painful form before they act. They position themselves when the structural conditions that produce currency debasement are being deliberately engineered. That is exactly what has been happening. The second force is central bank demand, and its scale over the past 3 years has no historical parallel since the end of the Bretton Woods system in 1971, when gold was officially decoupled from the US dollar. According to the Visual Capitalist's decade-long data summary, central banks purchased more than 1,080 tons of gold in 2022, more than 1,050 tons in 2023, and 1,089 tons in 2024. The 2025 figure came in at 863 tons, which, while lower than the 3 preceding years, still represents historically elevated demand that is geographically widespread. 22 central banks reported increasing their gold reserves by at least 1 ton during 2025. The National Bank of Poland led the pack, adding 102 tons and bringing total holdings to 550 tons, representing approximately 28% of Poland's total official reserves. The World Gold Council's 2025 Central Bank Gold Reserves Survey found that 43% of central banks indicated plans to increase their own gold holdings in the coming year, up sharply from 29% the prior year. Not a single respondent indicated intentions to reduce holdings. These decisions by central banks are not made lightly or impulsively. They are the product of long-term strategic analysis conducted by the most sophisticated economists and monetary policymakers in their respective governments. When the National Bank of Poland, the People's Bank of China, the Reserve Bank of India, and the central banks of Turkey, Singapore, and Qatar are all simultaneously adding to their gold reserves, they are making a statement about their long-term confidence in the US dollar as the world's reserve asset. They are quietly, methodically diversifying away from a system they believe is becoming less reliable as a store of value. Central banks now collectively hold more value in gold than in U.S. Treasury securities, a milestone that AGF Perspectives flagged as recently as February 2026. That is an extraordinary structural shift, and it did not happen accidentally. It is the calculated positioning of sovereign financial institutions that manage collective trillions in reserves. This brings us to the third major force, de-dollarization. The term itself has become somewhat politicized and is often dismissed as hyperbole, but the data tells a more nuanced and instructive story. JPMorgan, in a comprehensive mid-2025 analysis, acknowledged that de-dollarization entails a significant and ongoing reduction in the use of the US dollar in world trade and financial transactions. Investopedia's analysis from August 2025 observed that de-dollarization appears to be accelerating in Asia and the broader global south. BRICS nations, which now collectively account for a substantial share of global GDP and commodities production, have been holding strategic discussions about reducing their dependence on dollar-denominated trade settlement systems. While the creation of a formal BRICS currency has stalled politically, the underlying drive to reduce dollar dependence is real and measurable in the reserve data. Every central bank ton of gold, purchased at the expense of U.S. Treasury bonds, is a small act of de-dollarization in practice. Multiplied across dozens of nations and thousands of tons, it becomes a structural pillar of the gold bull market. The fourth force, often underappreciated in popular financial commentary, is the return of Western investment demand through exchange-traded funds. The World Gold Council data is unambiguous on this point. Gold ETFs globally attracted $89 billion in net inflows during 2025, a breathtaking figure compared to the mere $4 billion in net ETF flows the previous year. Total physically backed gold ETF holdings reached a new record of 3,932 tons, surpassing even the previous record set at the peak of pandemic-era uncertainty in October 2020. In Q3 of 2025 alone, the World Gold Council recorded the strongest single quarter of gold ETF inflows in history, at $26 billion, driven primarily by North American and European institutional investors. BlackRock, in a February 2026 research note, confirmed that gold ETF demand is showing no signs of slowing. As investors sought safety amid ongoing uncertainty, tariff tensions, and concerns about the durability of equity valuations, they systematically added gold exposure through the most accessible institutional vehicle available. The message embedded in those numbers is clear. The smart money, the allocators managing pension funds, sovereign wealth funds, endowments, and family office portfolios, decided in 2025 that they were meaningfully underweight gold, and they acted to correct that. Let us also examine what happened to gold mining equities during this period, because the leverage inherent in mining stocks and royalty companies created returns that outpaced even the dramatic rise in bullion prices. According to data from Capital.com's market analysis and corroborated by Seeking Alpha's sector review, Newmont Corporation, the world's largest gold miner by production volume, rose by approximately 130% during 2025, supported by record free cash flow of $1.6 billion in the third quarter alone. Barrick Mining, the second largest producer globally, delivered returns of approximately 160% over the same period. Agnico Eagle Mines, widely regarded as the operationally most efficient of the major producers, also performed exceptionally. In the royalty and streaming segment, companies like Wheaton Precious Metals and Franco-Nevada, which collect royalties and streams on gold production without bearing the full operational and capital risks of mine development, provided investors with leveraged exposure to higher gold prices while maintaining stronger margin profiles than traditional miners. Gold mining stocks, as Seeking Alpha's January 2026 sector review noted, put in a year for the record books in 2025, with many managing to double their stock price or better. But this is also where a clear-eyed discussion of risk becomes absolutely essential. Gold mining companies are not a direct substitute for holding the metal itself. They carry operational risks, political risks in the jurisdictions where they mine, cost inflation risks related to energy and labor, and management execution risks that can cause their stock prices to diverge significantly from the underlying gold price, sometimes to the downside. The concept of leverage cuts both ways. In years when the gold price consolidates or declines, mining stocks can fall far more sharply than the metal. An investor who bought Newmont shares at their 2022 lows experienced extraordinary gains, but an investor who bought at the 2020 highs endured years of underperformance even as gold itself maintained relatively stable value. This asymmetry is not a reason to avoid miners entirely, but it is a compelling reason to size positions intelligently and to understand the specific company, its cost structure, its reserves, its balance sheet, and its geographic exposure before committing capital. Understanding how to actually position oneself in gold requires thinking clearly about the different vehicles available and their distinct risk-reward profiles. The most straightforward entry point for most investors, whether in the United States, Canada, the United Kingdom, or across Europe, is through physically backed gold ETFs. The SPDR Gold Shares ETF, trading under the ticker GLD in the United States, remains the largest and most liquid gold ETF in the world, with assets under management in the hundreds of billions and a remarkably tight bid-ask spread that minimizes transaction costs. The iShares Gold Trust, trading as IAU, offers slightly lower expense ratios at 0.25% annually versus GLD's 0.40%, making it a compelling choice for long-term holders for whom cost efficiency matters. Sprott Physical Gold Trust, trading as fees, provides an additional layer of security by allowing investors to take physical delivery of their gold under certain conditions, which appeals to investors who want the liquidity of an exchange-traded product with some of the tangibility characteristics of direct bullion ownership. For European investors, products such as Xetra Gold in Germany and similar instruments listed on major European exchanges provide comparable access with VAT-exempt status in many jurisdictions. For investors who prefer actual physical ownership of the metal, bullion bars and coins remain the most direct form of ownership. In the United States, the American Gold Eagle and American Gold Buffalo coins issued by the U.S. Mint are widely recognized, easily marketable, and available through reputable dealers. In the United Kingdom, Gold Britannias and gold sovereigns minted by the Royal Mint carry the significant advantage of being legal tender, which renders them exempt from capital gains tax under current UK tax law. This is a point of considerable importance for UK investors because with gold having appreciated by more than 60% over 2024 and 2025 combined, the capital gains tax liability on a simple bullion bar position could be substantial. The Pure Gold Company's 2026 Guide to Tax-Efficient Gold Investment in the UK confirms this advantage explicitly. In Canada, the Royal Canadian Mint's gold maple leaf coins are among the purest investment coins available globally and trade with minimal premiums over spot price in most market conditions. Physical gold does carry costs that paper-based products do not. Storage in a bank vault, private secure storage facility, or a fully insured home safe all involve ongoing expense. Insurance against theft or loss adds another layer of cost. The spread between the buy price and sell price at most dealers is wider than for ETFs, typically ranging from 1 to 5% depending on the form factor and the dealer. And unlike an ETF or a stock, physical gold does not generate income. It does not pay dividends. It does not compound automatically. It is by design a store of value rather than a growth vehicle. These characteristics are not flaws. They are features for a certain kind of investor with a certain set of objectives, but they must be understood clearly before capital is committed. On the question of portfolio allocation, the data from financial advisors and institutional allocation studies provides a useful reference range. Yahoo Finance's investment analysis and surveys of financial professionals suggest that holding between 5 and 15% of a portfolio in gold is reasonable for most investors, with some higher risk tolerance accounts going to 20% in environments like the current one. Northern Trust's November 2025 research paper explicitly stated that investors are currently under-allocated to gold relative to what macroeconomic conditions suggest is appropriate. The investment case for gold in a portfolio is well established academically. Gold has a low to negative correlation with equities over long time periods, meaning it tends to rise when stocks fall, providing genuine diversification value rather than just cosmetic diversification. In periods of simultaneously high inflation and geopolitical stress, gold has historically outperformed most other asset classes. A portfolio allocation of roughly 10% to gold would not transform a conservative portfolio into a speculative one. It would, based on historical data, meaningfully reduce portfolio volatility while maintaining or enhancing long-term risk-adjusted returns. The tax implications of gold investment are meaningfully different across jurisdictions, and ignoring them would be financially costly. In the United States, the Internal Revenue Service classifies precious metals, including gold, as collectibles for tax purposes. This means that long-term capital gains on physical gold, gold ETFs backed by physical gold, and gold coins are taxed at a maximum rate of 28%, rather than the 15 or 20% long-term capital gains rates that apply to ordinary equities. Short-term gains on gold held for less than 1 year are taxed at ordinary income rates, which can reach as high as 37% in the top bracket. This tax treatment creates a clear incentive to hold gold for more than 1 year before selling to benefit from collectible rates rather than ordinary income rates. The most effective way for American investors to mitigate gold's tax burden is through a self-directed IRA, or a 401k, that permits precious metals investments, allowing gains to compound tax-deferred, or, in the case of a Roth IRA, entirely tax-free. Forbes and CBS News both highlighted in early 2026 that with gold having appreciated 65% in 2025 alone, managing the tax liability on gains has become a genuine planning challenge for investors who held gold positions outside of tax-advantaged accounts. In the United Kingdom, the tax picture for gold investors has been notably more favorable, particularly for those who made thoughtful choices about which gold products to purchase. Investment-grade gold bullion coins and bars are zero-rated for VAT purposes. Gold Britannias and gold sovereigns are additionally exempt from capital gains tax because they are UK legal tender. Other gold products, including gold bars, are subject to CGT at rates of either 18% for basic rate taxpayers or 24% for higher rate taxpayers, applied to gains above the annual CGT allowance. In Canada, gold is generally treated as a capital property, with gains taxed at the inclusion rate applied to capital gains. European jurisdictions vary considerably, with Germany imposing no capital gains tax on the sale of physical gold held for more than 1 year, making it among the most investor-friendly environments for long-term gold holders on the continent. The conversation about gold's future requires engaging seriously with the arguments against it as well, because intellectual honesty demands it, and because understanding the risks is what separates disciplined investors from those who simply follow momentum. The most significant risk facing gold at current price levels is that many of the conditions driving the rally become less severe or begin to reverse. If the Federal Reserve were to tighten monetary policy aggressively in response to resurgent inflation, real interest rates would rise sharply, increasing the opportunity cost of holding non-yielding gold. Historical data shows that gold underperforms markedly in high real interest rate environments. If geopolitical tensions in the major conflict zones of the world were to resolve unexpectedly and diplomacy were to prevail, some of the safe haven premium embedded in the gold price would deflate. If global fiscal discipline were to return, with governments meaningfully reducing deficits and stabilizing debt trajectories, the debasement narrative supporting gold would weaken. None of these reversals appear imminent based on current data, but rigorous investors acknowledge that markets can shift direction faster than consensus forecasts anticipate. Holding gold to a position size that reflects both your conviction and your capacity to withstand a meaningful correction is essential. Even in the strongest gold bull markets in history, interim drawdowns of 15 to 20% have occurred within multi-year uptrends. The 2008 financial crisis briefly pushed gold prices down by more than 25% before the metal resumed its powerful secular advance toward the 2011 highs. A gold investor who panics during a correction and sells converts a temporary paper loss into a permanent one. There's also the matter of gold supply, which often receives less attention than demand in popular commentary. According to the World Gold Council's 2025 full-year data, global mine production reached a new record of 3,672 tons in 2025, up approximately 1% from the previous year. Recycling activity grew 3% to 1,404 tons, a relatively muted response considering that gold prices increased by 67% in US dollar terms during the year. The total supply side remains constrained. Mining companies face extraordinary difficulty in bringing new major gold deposits into production. The average time from discovery of a major gold deposit to first production has lengthened considerably over the past 2 decades, often exceeding 10 to 15 years when permitting environmental assessments, community consultations, infrastructure development, and mine construction timelines are considered realistically. This structural supply constraint acts as a natural floor under the gold price. Even if demand were to moderate from its current extraordinary levels, the supply response from the mining sector cannot arrive quickly enough to generate a significant oversupply scenario in the near term. For investors who want leverage exposure to gold prices but are uncomfortable with the operational risks of individual mining companies, royalty and streaming companies deserve serious consideration. These entities, which include Wheaton Precious Metals, Franco-Nevada, Royal Gold, and Sandstorm Gold, provide financing to mining companies in exchange for the right to purchase a percentage of future gold production at a predetermined, typically well below market price. Because they do not operate mines themselves, they are insulated from the cost inflation, labor disputes, equipment failures, and geological surprises that make direct mining a challenging business. Their margins expand dramatically when gold prices rise because their purchase cost is fixed or indexed to a low rate, while their selling price rises with the market. In environments like the current one, royalty companies have historically delivered some of the best risk-adjusted returns in the entire natural resources sector. Their business models also tend to generate consistent free cash flow that supports dividends and share buybacks, which traditional gold miners often struggle to deliver due to the capital-intensive nature of mine development. The forward-looking institutional narrative around gold is increasingly aligned around a concept that has gained significant traction among macroeconomic strategists, the structural bull cycle. State Street Global Advisors titled its 2026 gold outlook explicitly around this thesis, asking whether the structural bull cycle can continue to $5,000. The State Street analysis points to Fed easing cycles, persistent structural demand from central banks, and de-dollarization as the 3 mutually reinforcing pillars of this cycle. JPMorgan's December 2025 Global Research Report echoed these themes, stating that central bank and investor demand for gold is set to remain strong, averaging 585 tons per quarter in 2026. Goldman Sachs' year-end 2026 target of $5,400 per ounce implies further upside of approximately 10% from current levels of roughly $4,933, while JPMorgan's more ambitious projections stretch towards $6,000 per ounce over the longer term. Macquarie, another major institutional research house, has also hiked its 2026 gold forecasts substantially. These are not uniform predictions, and it would be misleading to present any price forecast as certainty, but the convergence of major institutional views in the same directional range is itself a meaningful data point. It is also worth noting what is happening at the retail level, because while the institutional demand is structurally more important, the retail surge of 2025 tells its own story about changing public awareness of gold's role. Bar and coin demand globally reached a 12-year high in 2025, with total demand of 1,374 tons, up 16% from 2024. The strongest growth came in gold bar purchases, which rose 24% to 1,068 tons. In the fourth quarter of 2025 specifically, bar and coin demand hit 420 tons, the highest level for a fourth quarter in the dataset. Across North America, Europe, and parts of Asia, individual investors were entering bullion dealers and online precious metals platforms at a rate that surprised even industry veterans. In Germany, where retail physical gold investment has always been culturally significant, demand accelerated noticeably. In the United Kingdom, the Royal Mint reported exceptional demand. In the United States, platforms like JM Bullion and APMEX reported extended wait times on some products. The retail investor was arriving, but notably, the retail investor was following the smart money rather than leading it. Central banks and institutional investors had been loading up since 2022. The retail surge of 2025 represented a broadening of the ownership base, which in historical commodity cycles has tended to mark the middle of a major bull market rather than its end. For anyone considering building or expanding a gold position at current price levels, the psychological challenge is real. Human psychology makes it genuinely uncomfortable to buy an asset that has already risen by 140% over 2 years. The instinctive concern is that you are arriving late, buying near a top, and setting yourself up for disappointment. But investing on the basis of price-performance momentum alone, either in the positive or negative direction, is not analysis. It is extrapolation. The relevant questions are not whether gold has already risen, but whether the fundamental conditions driving that rise remain intact. Based on the data discussed throughout this examination, the structural drivers appear durable. Governments are not meaningfully reducing deficits. Central banks are not reversing their gold accumulation strategy. The geopolitical fragmentation that makes gold attractive as a reserve asset is not abating, and the supply side cannot respond rapidly to higher prices. This does not mean gold must rise continuously from here. It means the underlying case for holding gold as a meaningful portfolio allocation remains valid regardless of the starting price point. A practical approach for investors seeking exposure at current levels involves several actionable steps rooted in financial discipline. Rather than committing an entire intended gold allocation on a single day, consider a systematic purchase approach, buying fixed amounts at regular intervals over 3 to 6 months. This reduces the emotional weight of timing and ensures that if prices pull back temporarily, you accumulate more ounces at lower average costs. Begin by assessing your total portfolio size and determining what percentage allocation to gold aligns with your risk tolerance and investment time horizon. For a moderate risk investor with a time horizon of 5 to 10 years, somewhere between 8 and 12% of a total portfolio in gold-related assets would be broadly consistent with institutional best practices. Within that allocation, consider dividing between a physically backed gold ETF for liquidity and convenience, a small physical bullion holding for genuine emergency preparedness purposes, and a modest position in a diversified gold royalty company for additional leverage to the price. If you are in the United States, strongly consider holding at least a portion of your gold ETF allocation within a tax-advantaged account, such as an IRA, given the 28% collectible gains tax rate that applies outside such accounts. When evaluating gold ETFs, prioritize 3 criteria: the quality of the custodian, the expense ratio, and the trading liquidity. SPDR Gold Shares has a decades-long track record with custodial arrangements through HSBC's London Vault, holds physical gold allocated specifically to the fund, and has been audited consistently. iShares Gold Trust similarly holds physical gold and provides quarterly independent audits. Be cautious about leveraged gold ETFs, which use derivatives to deliver multiples of the daily gold price return. These products are designed for very short-term tactical trading, not strategic allocation. A 2x leveraged gold ETF does not deliver 2x the annual return of gold over a full year. Compounding effects cause daily leveraged returns to deviate significantly from simple multiples over longer holding periods, almost always to the investor's detriment. For investors in the UK, Canada, and Europe, the local tax landscape should be the starting point for structuring any gold position. A UK investor who holds gold Britannias in an allocated account at the Royal Mint or a comparable institution gets the dual benefit of CGT exemption and complete insulation from counterparty risk. A German investor who buys gold bars and holds them for more than 1 year pays no capital gains tax on the eventual sale under current German law. A Canadian investor using a tax-free savings account equivalent that permits gold-backed products can shelter gains from taxation entirely. These are not obscure loopholes. They are standard features of each jurisdiction's investment framework that reward knowledge and planning. Looking further into the future, the macro conditions that have driven gold's rise show no signs of structural resolution. The global fiscal situation is deteriorating rather than improving across most major economies. The U.S. Congressional Budget Office, European fiscal watchdogs, and the IMF's latest estimates all project sovereign debt levels continuing to rise as percentage of GDP across the G7. The geopolitical multipolar shift that began with the Ukraine conflict's transformation of European security assumptions, continued through the realignment of Middle Eastern energy diplomacy, and deepened through the BRICS expansion of recent years, is not a temporary event. It is a structural reconfiguration of the international order that typically unfolds over decades rather than years. In every previous instance where the global monetary and geopolitical order underwent fundamental restructuring, gold emerged as one of the primary beneficiaries. The 1970s, when the Bretton Woods gold standard broke down and inflation ran rampant, saw gold rise from $35 per ounce to more than $800 per ounce in a decade. The post-2008 era, when central banks embarked on unprecedented quantitative easing programs, saw gold rise from roughly $700 to more than $1,900 by 2011. The current cycle, rooted in fiscal excess, geopolitical fragmentation, de-dollarization, and a fundamental reassessment of what constitutes reliable monetary value, has structural characteristics that compare favorably to both prior episodes.